In the world of finance, the U.S. Federal Reserve is a key player whose decisions can significantly impact the global markets. Over the past 14 months, the Fed has implemented a monetary tightening cycle, including 10 consecutive interest rate increases, which has taken the federal funds rate to 5.25%. This tightening cycle has also had a significant impact on the world of cryptocurrencies, particularly Bitcoin and Ether. In this article, we'll take a closer look at what the recent decoupling of Bitcoin and Ether from traditional assets means for the future of crypto after the Fed rate hike. Declining volumes and reduced activity. One of the first things to note is the declining volumes for both Bitcoin and Ether. These volumes have been trailing their 20-day moving averages, indicating that investors are staying on the sidelines to a certain extent. This reduced activity implies that economic data points are having a muted impact on digital assets. In other words, investors are taking a wait-and-see approach to the market. This reduced activity also suggests that Bitcoin and Ether may trade within a range, absent any specific catalysts. While this scenario won't provide a lot of immediate alpha, it also won't lead to significant downside misery. Decoupling from traditional assets. Another significant development is the decoupling of Bitcoin and Ether from traditional assets. At the beginning of 2023, Bitcoin had a daily correlation coefficient of nearly 0.90 with the S&P 500, Nasdaq, and Dow Jones Industrial Average, DJIA. However, this correlation has since declined to close to zero. This lack of correlation between BTC and traditional assets suggests that investors are viewing the impact of monetary policy differently for digital assets than for stocks, at least for the moment. BTC's correlation with copper, the US dollar, and gold has also declined. What's next for crypto after the Fed rate hike? So, what does all of this mean for the future of crypto after the Fed rate hike? Let's take a closer look. First, it's important to note that Bitcoin and Ether are still relatively new assets. They have only been around for a few years, and their market dynamics are still evolving. As such, it's difficult to predict with certainty what will happen next. However, it's clear that the recent decoupling from traditional assets is a significant development. It suggests that investors are starting to view Bitcoin and Ether as separate, standalone assets rather than simply as speculative investments. This could lead to increased stability and a more mature market. Another possibility is that we could see increased institutional investment in Bitcoin and Ether. Institutional investors are often more risk-averse than individual investors, and they tend to seek out stable assets that can provide long-term returns. If Bitcoin and Ether continue to decouple from traditional assets and stabilize, they could become more attractive to institutional investors. On the other hand, there are also risks to consider. For example, if the Fed were to implement further rate hikes, it's possible that Bitcoin and Ether could be negatively impacted. Additionally, there is always the risk of regulatory intervention, as governments around the world are still grappling with how to regulate cryptocurrencies. Bitcoin's resilience during the Fed rate hike. One interesting aspect to note is Bitcoin's resilience during the Fed rate hike. Despite the tightening monetary policy, Bitcoin has managed to hold its value and even experience some growth. This is a significant departure from what happened during the last Fed rate hike cycle in 2018, when Bitcoin experienced a significant decline in value. Some analysts attribute this resilience to the increased institutional investment in Bitcoin and the growing recognition of Bitcoin as a legitimate asset class. Ether's growing use case. While Bitcoin has been receiving most of the attention lately, it's important not to overlook Ether. Ether is the cryptocurrency that powers the Ethereum blockchain, which is the foundation for a growing number of decentralized applications, DApps. As the use cases for DApps continue to expand, the demand for Ether is likely to increase as well. This could lead to a decoupling of Ether from Bitcoin and traditional assets, as Ether becomes viewed more as a utility token than a speculative investment. The role of crypto exchanges. Another important factor to consider in the future of crypto after the Fed rate hike is the role of crypto exchanges. These exchanges are the primary way that investors can buy and sell cryptocurrencies, and they have a significant impact on the overall market. As the market dynamics of Bitcoin and Ether continue to evolve, it's likely that we'll see changes in the way that crypto exchanges operate. For example, we could see increased regulation of exchanges, which could lead to greater stability but also higher fees and reduced access for smaller investors. The importance of blockchain technology. Finally, it's worth noting that the future of crypto after the Fed rate hike is closely tied to the future of blockchain technology. While cryptocurrencies are the most well-known application of blockchain technology, there are many other potential use cases as well. For example, blockchain technology could be used to improve supply chain management, increase transparency in government, and provide secure digital identities. As blockchain technology continues to evolve and gain mainstream acceptance, it's likely that we'll see continued growth in the cryptocurrency market as well. Conclusion. In conclusion, the recent decoupling of Bitcoin and Ether from traditional assets is a significant development that could have important implications for the future of crypto after the Fed rate hike. While it's difficult to predict with certainty what will happen next, it's clear that the market dynamics of Bitcoin and Ether are evolving. Investors are starting to view these assets as separate, standalone investments, which could lead to increased stability and a more mature market. However, there are also risks to consider, including the potential impact of further rate hikes and regulatory intervention. As the market evolves, it will be important to keep an eye on factors such as institutional investment, the growing use case for Ether, the role of crypto exchanges, and the broader adoption of blockchain technology.